Hey, what's up everyone? Welcome back to my world of stocks. So with the market falling pretty hard recently, especially on an individual basis where we've seen many popular stocks take big hits as the economy struggles and investors fear the high interest rates that can cause a recession if the Fed doesn't reverse course soon. Well, I actually thought that it'd be fun to quickly share with you 10 stocks, that's right, 10 of them, that I think look super attractive right now on the current dips that we're seeing with them. And I chose a wide variety here of different risk levels too, some that I feel are extremely safe while others are a lot riskier, just to give you more variety and different things to look at and consider. All of them, though, I think are very attractive for their own unique reasons, which I'll quickly touch on for every single one of these in kind of a rapid fire style as we quickly run through the list. So it's going to be a ton of fun. I hope you all enjoy this. And if you do, please consider hitting that like button and subscribing. Really helps keep my channel alive. And thank you so much for that support, my friends. But look, if you're ready for this one, I can't wait to share with you 10 stocks. It's going to be quite a lot. So let's just jump into it. I'll go through the list as fast as I can here. But jumping straight into it. All right, for my first pick, I gotta go with Google, probably my number one most favorite stock in the entire market. And look, seeing their stock fall by over 13% in the past week and down over 15% from the top, for me, that's a good enough dip to be adding a little more to my position here. And that's because Google continues to dominate virtually all parts of the internet market, which in my opinion is the most important market of all. And as their most recent earnings showed, Google is not even really slowing down. I mean, sales reached almost $85 billion in a single quarter, and that was still up 14% year over year, with net income profits also skyrocketing by almost 30% up to almost 24 billion. These are very strong margins that we're talking about here, very strong profitability, and I believe that there's even more to come in the future. Google is the third largest cloud provider in the world. We know how profitable that is for Amazon, of course, but Google is just getting started there, reporting a record 1 billion in operating profit for the first time ever last quarter. YouTube is also capturing more viewers than any other streamer in the world, including even Netflix. And when you look at Apple, the most highly valued company in the world, well, Google is trying to imitate them with their own Pixel lineup of products and services, all through Android, which they also own too. And by the way, they have a new lineup getting announced this upcoming week for the Pixel 9 lineup of phones, including also a new foldable, which I'm excited to take a look at myself too. All of which will have more AI integration in them as well through Gemini, which I do feel they're beating Apple to the punch on as well. So I just think Google is on fire and the stock is a buy on any significant dips. Stock number two, I'm going with Cisco, probably my favorite value dividend type of stock in the market right now, or at least a big contender for that spot, with another 6% drop this past week. And despite them closing on a very important acquisition of cloud and AI specialist Splunk, probably my favorite acquisition of the year, by the way, and yet the stock is actually negative year to date. At these levels, their adjusted PE is not only 12% cheaper than their 5-year average, but also 42% cheaper than the sector median, while the dividend has also risen to about 3.5% yield, which is also among the highest levels that it's ever really reached. So I just think Cisco has been undervalued for a while now, and it is a great pickup here. They have faced financial pressures in the past without a lot of growth, but recent moves shifting heavier into a higher margin software driven business, especially in cloud, AI, and even cybersecurity, I think will pay off for them long term, as those are all very high growth markets with lots of future potential. Speaking of AI though, stock number three, well, it literally has it in its name and their ticker symbol, and that is C3.ai, ticker symbol AI, who's now seen close to a 20% fall in the past month, while also being down over 80% from their 2020 IPO. A big reason for that, it was overhyped to begin with during a rise in AI and internet-based stocks that later fell heavily on the weakening economy. And because C3 has not been profitable, well, the rising interest rate environment has scared investors into selling and even shorting the stock heavily, because of that lack of profits. However, if interest rates start coming down soon, this could be one heck of a turnaround play here, as their business often reminds me of that of Palantir's, except at a much smaller scale, but also with a lot of that similar potential, as they basically use AI to improve the operational efficiency and effectiveness of other businesses, which is very similar to what Palantir does too, and it's in very high demand. Now, I'm not saying that they're the same. I'm not even saying that they're really all that comparable. I'm just saying that there are some similarities here that could propel the stock higher over the long term as AI becomes more important and more heavily used by businesses, and especially at these beaten down levels in the stock price, I think it looks very attractive. All right, moving on. If you feel C3 is just way too risky, well, I totally understand. I agree that it is a very high risk stock, but stock number 4, it's about as solid of a pickup as I could really make right now in the market. Very dependable. I have almost the same amount of conviction for it as I do for Google, and that is, of course, the mighty Amazon, ticker symbol AMZN, who also saw a dip this past week, losing over 10%, while also being down about 17% in the past month, coming off of earnings that Wall Street didn't really approve of, but that I actually thought were phenomenal, especially for their size, with sales still rising by a double-digit rate, despite them already doing close to $150 billion in a single quarter. That is insane. And most important of all, Amazon continues to show progress on the bottom line, which used to be their biggest critique. Well, in the past quarter, they almost doubled it. So there's really nothing to complain about it anymore, I feel, when it comes to Amazon and their performance. They're the number 1 cloud provider in the world, and yet they still managed to grow it by almost 20%. It's wild. Plus, they're also investing heavier into AI now too, mentioning recently that they're basically buying up as many NVIDIA GPUs as they can get their hands on to run AI training and generative AI models, with the goal being to generate billions in new revenue from that too. So again, the story with Amazon continues to be that even for their incredibly massive size, they still continue to find new ways to grow. And in the future, by the way, I feel that when they do finally start turning their attention more heavily into profitability rather than revenue growth, I think the valuation will actually look much more attractive at today's levels than people realize. Upping the risk a little bit though for stock number 5, I'm actually going to go with a bit of a Tesla competitor in General Motors, ticker symbol GM. And for this one, my thesis is pretty simple. I often get comments on this one whenever I mention that I like GM stock. I get comments from some people calling me an idiot, saying that Tesla is so much better, and that how could I talk about GM when Tesla's out there? But that's never really been at all my point with GM. I don't look at General Motors as an alternative investment to Tesla. I actually have a huge position in Tesla, whereas GM is a very tiny one by comparison. And I don't buy GM stock with the idea that they'll overtake Tesla in anything, and especially not in AI, energy, robotics, or any other kind of revolutionary technologies. I simply own a small piece of GM stock for being a cheap, and I would argue undervalued, automaker that is more likely to survive long term in an EV and even autonomous driving market that is more than big enough to support multiple players like Tesla and GM. And when I look at the valuation, it just makes sense to me. Now, more recently, the stock dipped again, losing close to 10% in the past month, while also being down about 1/3 of its value from the top, and also looking relatively flat over the past decade, which leaves behind a dirt cheap valuation that is enormously cheaper than the sector. In fact, their forward PE is only less than 5 and over 71% cheaper than the sector too. And yet I actually think that the business is doing pretty well right now, with last quarter in particular beating analyst expectations on both the top and bottom line, while raising cash flow guidance and growing their adjusted profits by a massive 37% on also record sales. That's not to say that there aren't any issues, notably their declining business in China that remains a concern. They're trying to work on it, doing restructurings within the business and stuff like that. But even with EVs, for example, they've made significant progress, with last quarter seeing a 40% spike in EV sales, despite the market being very unfavorable to them right now. Of course, the other major thing holding GM back has been the economy and rising interest rates that make it too expensive for consumers to buy new cars. But if rates start coming down soon, don't be surprised if GM actually survives this current downturn a lot better than people expect. Now, like I said, I usually get some not too friendly comments about GM stock, and yet that's really nothing compared to stock number 6 in Disney, ticker symbol DIS, who, look, I totally get it. I'm just as critical as you guys about Disney stock and the quality of the content that Disney has been putting out lately, which has been severely lacking, especially in Marvel and Star Wars. I'm a huge Marvel and Star Wars fan. I always have been my whole life, and the content that they've been putting out lately has been, yeah, pretty bad, receiving horrible reviews. It's just not what customers are really responding to, and the quality is just not there. So I'm very critical of all of that. I just feel that, I try to be optimistic about this ship being able to be turned around. And like I mentioned recently, I do think that we're seeing at least some positive signs there, notably with Deadpool generating the biggest sales of any R-rated movie in history, and also with the announcement of Robert Downey Jr. returning as Doctor Doom in the Marvel Universe. I think they have an opportunity there because of the expanded universe to bring in old characters and different characters and do a lot of creative things that could bring the quality back up again and give customers what they actually want. Plus, another major concern for Disney has always been the heavy cost of video streaming without any profitability to show for it. But this past week, well, they actually reported positive profits for the segment for the first time ever too, which I think is another good sign. And yet the stock actually fell on concerns of a challenging macroeconomy and how that might affect customers wanting to visit their theme parks and resorts. But with the stock now down over 8% in the past week, after losing over half its value from the top, while also trading for just about the lowest prices of the past decade, I just don't think we would have ever got this low of a price for Disney if there weren't some concerns that need to be addressed. But at these levels, I just can't resist buying some of this stock. I happen to like it. All right. How about for stock number 7, though, I bring you back to a fan favorite here that most of you probably like. You probably even own it in your portfolio. That's right, we're going with NVIDIA, ticker symbol NVDA, basically the leader of the AI revolution at this point, or at least the most hyped one for it for sure. But you know what? I'm actually going to include stocks number 8 and number 9 here as well, because I actually think all three of the big American chip developers are going through a large dip that is worth picking up. And it really just depends on what characteristic you would prioritize among them the most. That would really determine which one is the most attractive here. But that, of course, includes NVIDIA, AMD, and Intel. Now, when looking at their prices, NVIDIA lost almost a fifth of its value in the past month. AMD lost almost a quarter of its value during the same time. And Intel, well, Intel lost over 40% and is now trading at the lowest prices of the past decade after losing more than 70% of its value from the top. And so what I think it will really come down to here, differentiating between the three, I think with NVIDIA, you get the number one market share dominant leader in AI and discrete GPUs with close to 100% of the data center GPU market, which is, by the way, also up 5 times last year in sales. And they have about 88% of desktop GPU market share as well. And despite being one of the most highly valued companies in the world now by market cap, well, their profit growth is so incredibly high that the recent dip left their valuation significantly lower than both their 5-year average on most metrics, while also their PEG ratio is even cheaper than the sector too, if you can believe it. So with that dip and with the growth expected from AI long term, I think NVIDIA is a buy here for those reasons. Now, when it comes to AMD, well, you're talking about a little more risk here. Obviously not as dominant as NVIDIA, but you're still talking about the second largest in GPU market share. There's going to have to be an alternative there. Businesses will want to turn to someone else too if they can compete on price and other things. Plus, AMD has also been eating away at Intel's market share for CPUs too for a long time. They've been the second kind of alternative in that area too. So I think they could try to bring some of that success over to GPUs with, competing against NVIDIA as well. Doesn't have to be better than NVIDIA, doesn't even have to be better than Intel, just needs to be a good alternative. And when you look at the valuation, it's cheaper than the sector, even by a larger margin than NVIDIA too. So that's pretty attractive as well on this dip. And then with Intel, you're really just betting on a big recovery here for what used to be the most dominant player in the space. And I don't think they need to be number one, by the way. I just think that they need to do a better job competing with new products in especially artificial intelligence, which they are launching multiple for in CPUs, GPUs, and even AI accelerators, which are a new type of AI chip. And then on top of that, they need to cement themselves as really I would say like the one of the big three to actually build chips in America, helping the West diversify away from the East, away from Asia, which will include huge incentives, subsidies, and even help with them attracting other businesses to build chips for them too, and even other developers too. So all three of these stocks, in my opinion, look like a buy on these dips. And I personally own a really big position in NVIDIA and then a very small position by comparison, tiny one really, in Intel. Okay, finally for stock number 10, I gotta include my number one largest holding in Microsoft, ticker symbol MSFT, who didn't experience quite as large of a fall as many of the other stocks recently, but it did at least dip by a double-digit % over the past month, despite posting what I thought were, once again, some of the best earnings that we ever see out of companies in the entire world this past quarter, with not only sales still rising by over 15% on about $65 billion worth of revenue, but net income profits also coming in really high at over $22 billion, with about 10% growth there as well. And when looking at it, Azure Cloud, the second largest in the world, it continues to grow at around a 30% clip, with just about all other parts of their business putting up incredible growth for its size too, especially in Xbox gaming, which used to be struggling but is now posting growth north of 60% and is shaping up to easily be considered the next Netflix of gaming type of service, with already more than 500 million monthly active users across all their platforms, which was in large part thanks to the massive Activision acquisition, which is just another reason why I love Microsoft stocks so much. They are so incredibly profitable that they can afford to just really scoop up other companies left and right to maintain that dominance, which you can see on this rolling screenshot here of all their acquisitions, including some very notable ones in recent years, including like Activision, LinkedIn, GitHub. Those were all massive ones that are paying off for them in huge ways. And also in artificial intelligence, last quarter, Microsoft saw more demand from AI for their services than they even had capacity for. So like Google, like Amazon, like NVIDIA, this is another giant company here that is firing on all cylinders right now that I think is a great one to pick up on any significant dips. But that's going to do it for my list. What do you guys think? By the way, I'll mention a quick honorable mention because I'm planning on making a separate video for it, but SoFi is looking very attractive right now as well, but I want to make a separate video on them and their earnings and talk a little bit more about that one soon. So hopefully I'll get that video out to you guys. But anyway, let me know if there's any stocks that you think should be on this list. I'd love to hear about them. And thank you again for all your support, my friends. It means so much to me. I hope you're all doing well. I wish you the best of luck out there, and I'll catch you in the next video. All right, take care, everybody. Bye-bye.